Hey everyone, and welcome. If you've ever felt like investing is a super complex, confusing world that's only for experts, then you're in exactly the right place. Today, we're going to break it all down. We're going to demystify the entire thing and show you exactly how to get started, even if you're an absolute beginner. All right, so here's our roadmap for today. First up, we're going to talk about something I call the incredible shrinking burrito, which really gets to the heart of why we need to invest in the first place. Then we'll get into the two superpowers your money gets when you invest it. After that, we'll figure out your very first investment choice, and we're going to keep it simple. Then we'll cover the single most important strategy for success, the just keep buying secret. And finally, we'll wrap up with the right mindset for playing the long game. So, first things first, why do we even need to do this? I mean, why can't we just stash our money in a savings account where it's safe? Well, it all comes down to a simple and kind of sad story about lunch. I mean, think about this for a second. Let's say you had $50,000 a few years back. That was enough to buy you almost 6,000 Chipotle burritos. But today, that exact same amount of cash gets you over 1,700 fewer burritos. Nothing changed about your 50 grand, but what it can actually buy you? Yeah, that changed. A lot. So what's going on here? The culprit has a name. Inflation. You can think of it as this quiet, invisible force that's constantly making your money worth a little bit less over time. Now, a little inflation, around 2 or 3% a year, is actually considered healthy for an economy, but what it means for you is that any cash just sitting there is losing its buying power. It's like you're on a financial treadmill. You have to be moving forward just to stay in the same place. If you stand still, you're actually going backward. Okay, so if leaving our money in the bank means it's slowly losing its power, what's the answer? Well, we have to put that money to work. And when we invest it, our money gets two incredible superpowers to fight back. Superpower number one is just flat out beating inflation. So take a look at this. While inflation is chipping away at your money, maybe 2 to 3% a year, the stock market has historically grown by an average of 8 to 10%. That's a huge difference. By investing, you're not just keeping your head above water, you're actually growing the real value of your money. And that brings us to the second superpower. And honestly, this is where things get really, really exciting. You've probably heard that old saying, it takes money to make money. Well, compound interest is exactly what people are talking about. It's like magic. Let's make this super simple. Imagine you invest $1,000, and let's say you get a 10% return in the first year. Great. After 1 year, you have $1,100. You made $100. Pretty straightforward, right? But here's where the magic kicks in. In year 2, you don't just earn 10% on your original $1,000. No, you earn it on the entire $1,100 that you now have. That means your earnings from last year are now earning their own money. Let that sink in for a second. Your money is starting to work for you. Now, let's hit the fast forward button and see what this looks like over the long haul. After 20 years of that same process, your initial $1,000 investment has snowballed into over $6,700. And that's without you adding another penny. That's just the power of your money working for itself over and over again. It's an exponential curve, and the most important ingredient is just time. Okay, so we've got the why. We know we need to invest to beat inflation and use the power of compounding. But the big question is, what do you actually invest in? There are a million options, so let's keep this as simple and as powerful as possible. So you've basically got two paths. You could try to pick individual stocks, buying shares in just Apple or just Tesla. That's kind of like trying to pick the one-star player who's going to be the MVP of the season. It's high risk, takes a ton of research, and it's really hard to get right. Or you could just bet on the whole team to win. That's what an index fund does. It's diversified, it's low effort, and historically, it's a winning strategy. So what exactly is an index fund? Well, think of it like a bundle deal. It's one single investment that automatically buys you a tiny little piece of every single company in a major market index. The most famous one is the S&P 500, which is just the 500 biggest companies in the US. So with one click, you own a piece of Apple, Microsoft, Amazon, all of them. You're instantly diversified. And to buy one of these, all you need to know is its ticker symbol. And I love this analogy because it makes it so clear. A ticker symbol is basically just an airport code for an investment. You know how JFK gets you to New York and LHL gets you to London? Well, a ticker like VOO gets you the S&P 500 index fund. It's just a simple 3 or 4-letter code for what you want to buy. Simple as that. All right, we know the why, to beat inflation, and we know the what, an index fund. But now we need to talk about the how. And this might just be the most important part, because your strategy is everything. Luckily, the best strategy can be summed up in just 3 words. This quote from Nick Majuli, honestly, it's the secret sauce. The biggest mistake that new investors make by far is trying to time the market. They're always waiting for the perfect moment to get in. But the reality is that perfect moment doesn't exist. The winning strategy is just to be consistent. Market high, buy. Market low, buy. Just keep buying. Now, this strategy has a name. It's called dollar cost averaging, and it's incredibly powerful because it's so simple. All you do is pick an amount you're comfortable with, say $100. Then pick a schedule, like the first of every month. Then you set it up to happen automatically. That's it. When the market is high, your $100 buys a few less shares. When the market dips, your $100 buys more shares. Over time, it all averages out, and you've taken all the stress and emotion out of the equation. And look, if you're still tempted to wait on the sidelines, these numbers show you exactly why that's a bad idea. For one, on average, the market hits a new all-time high about 21 days a year. So if you're waiting for a dip, you're mostly just going to miss out on the climb. And get this, data shows that if you missed just the 10 best days in the market over 30 years, your returns would be cut in half, by 54%. The cost of waiting is almost always higher than the risk of just getting started. Okay, this brings us to our final and, I think, most critical section, your mindset. Because investing isn't just about numbers and charts, it's a psychological game. And your mindset will determine whether you win or lose. Take a look at this because it tells a really powerful story about risk. In any single year, the market can go down, and when you're new, that can be terrifying. But watch what happens as you zoom out, as you extend your time horizon to 10 years, then 20 years, then 30. Those negative periods basically vanish. In fact, historically, there has never been a 20-year period where the US stock market has lost money. So what does this all mean for you? It means that time is your greatest asset. It's your ultimate superpower. The more time you have, the more you can ride out any scary downturns. And, most importantly, the more time you give that compounding magic to really do its thing. Your long-term view allows you to ignore all the short-term noise and just focus on the goal. And that's really it. This right here is your game plan. Step 1, understand your why. You're doing this to beat inflation and let compounding build your wealth. Step 2, open a brokerage account online. It's super easy, just like opening a bank account. Step 3 is set up that automated, consistent investment into a broad index fund. And step 4, the hardest part, just stay the course and let it grow. We've gone over a lot today, but it all comes down to taking that first small step. Building wealth really is a marathon, not a sprint, and the race begins the moment you decide to start. So the only real question left to ask is, what's that first step going to be for you?